to help you puzzle out how investors think, what you should and shouldn't say, and the psychology of how venture capital works. Because honestly, those secrets are not well known outside of Silicon Valley. And frankly, I don't think it's right that they're so guarded. There's way too much gatekeeping, and way too much funding goes to people who already know each other, when the fact is that the best ideas could be coming from anywhere in any corner of the world, including yours. So if that's why you're here tonight, I hope that you'll join me to toss in a question or two. And we're going to turn on the chat room here and have people come and join me as well. So if you are on LinkedIn or Facebook or what's the other one? Oh, YouTube, of course. So now it's up to you. You can fill in that chat room and I'll be happy to talk to you. Let me know where you're from, where you're watching, and what you're working on. And of course, if you have questions, I'll be happy to do that as well. So if you're going to want to join me backstage as well, we give priority to those folks who are members at startupcouncil.org. And that's the organization I mentioned a minute ago. And you can head over to startupcouncil.org anytime to check that out. But if you're watching on YouTube or LinkedIn or Facebook, please let me know if you can hear me. And that you can see me. That looks like Roger. Hey, Roger, from looks like a YouTube. And Nelson. Hi, Nelson. Nice to meet you both. And hello from Tustin. Okay, that's right here. Hello from how much of a startup's business plan should be founded? Okay, yeah, well, we can get to that in a minute. Absolutely, we can talk about all those things. I guess you can hear me and see me. Is that the is that the thumbs up I'm getting from you guys? I appreciate that. Just let me know. I don't see anybody on LinkedIn yet. Is there anyone out there on LinkedIn checking in? Because sometimes we have trouble with that, and I can't look at two things at once, or it'll knock down the bandwidth. So if anybody's on LinkedIn, please chime in before we get going. I want to make sure we've got all our followers there as well. That'll take just a second. So let me just tell you a few things before we get rolling here. So we have to do a couple disclaimers, and then I have a new special offer for you. Okay, Suresh checking in from Bangalore, and Ashley from New York. Excellent. Nice to meet you both. And I wanted to tell you about, let's see here. What do we got here? So here we go. Like and subscribe, of course. That's the, that's the standard issue for social media these days. And I mentioned this new book, right? So the new book will be coming soon. So you want to get on our mailing list from over at startupcouncil.org so you can get free excerpts when it starts happening. But there we go. There's a LinkedIn user. Cool. AI? Are you AI or are you Al? I'm not sure. Oh, Julia from MKE just left the Summerfest Tech AB. Julia, that's too many acronyms for me. I'm not sure what MKE is or AB. Maybe Alberta, Canada? But maybe you can fill us in. But what I was looking to show you was, let's see, this. Sorry. Okay, so I need to do a couple disclaimers. This is not qualified legal or financial advice. Every situation is different. I'll do my best to try to help you, but don't rely on any of this. I'm just some guy you met on the internet, and we all know how sketchy that can be. Also, this is being recorded and will be shared worldwide, so don't say anything stupid. Other than that, those are the ground rules, and encourage you to come and join us over at startupcouncil.org. Like I said, there's a lot going on there. We actually have, I think it's 9 newsletters now, and we just launched a whole bunch of new discounts. There are over $5 million worth of discounts available at startupcouncil.org now for our members, right? So really good stuff like AWS and Notion and Dropbox and DocSend and all kinds of stuff you actually use, QuickBooks, and they're long-term discounts. They're not just affiliate links. There's stuff that we especially negotiated for our members worldwide. So if that sounds interesting to you, head over to startupcouncil.org. Okay, so let me see. There's OG from Chicago. And good evening or morning, Suresh says. Yeah, in Bangalore, let's see. It's morning in Bangalore. It's night here in California. But that's why I do this at night, Suresh, especially trying to reach folks in India to try to be helpful over there. So I hope this is helpful. Please tell your friends. I wanted to give you the link for if anybody wants to come backstage and talk. Otherwise, it's just me talking, which is okay with me. I'm a pretty good talker. But where's the link for the backstage? Sorry, guys, hang on one second. I'm trying to give you the one that isn't really hard to type in, That's not it. Oh, there it is. Okay. So you could go over here if you'd like to come on backstage live, turn on your webcam and talk to me directly. That's best, especially if you want to pitch, like practicing your pitch. We do a 2-minute flat pitch, no slides or presentation. Just talk for 2 minutes, and that gives us enough to give you hopefully helpful critique, and it'll be friendly and helpful. Don't worry, very constructive here, and happy to do that if anybody wants to come backstage. So founderofficehours.com, and that will link you over to a special private chat room and get you on camera here with me if that sounds like fun to you. So other than that, let's get going with some questions, and I've got some other special offers to tell you about as we go through the evening. But there was one question. I think John already had a question, right? So he got first blood there. Yeah, John says, how much of a startup's business plan should a founder share in an angel financing directory? Okay, so I'm not sure exactly what that means. How much of a plan should a founder share in? And I thought that was a good question, John, but unfortunately I don't know what you're talking about. What you're asking me, if you can clarify, and we'll try again. I thought it was pretty close there. I mean, let's see here. So I guess the question I thought you were asking, and maybe this is it, and you can chime in if it is or not in the chat room, but how much of a company should the founder own after an investment? That's a common question I get, because venture capital, we're really talking about venture capital style businesses here tonight. And venture capital businesses are funded in waves, or we call them tranches or series. And so there's like a pre-seed, a seed, and then Series A, Series B, Series C. So once you get on the venture capital wheel, it's kind of like a hamster wheel, right? You just keep going. And the expectation is that you will raise money again in, say, maybe 18 or 24 months. Every 2 or 3 years, you're raising another bigger round because you're growing larger and larger. That's the whole venture capital game. So it's a common question, how much of the company should I give up in each round? And the answer is roughly, it depends on a lot of things, right? But just to get your head around this isn't like a one-time cash infusion and then you grow to become Facebook, right? Big companies like that raise multiple rounds. They start with a couple million and then tens of millions and hundreds of millions. And these days they raise billions. It's insane, right? So the rule of thumb, I would say, is roughly think about each round as the founder or founding team, like you and a co-founder or two, are giving up something, again, very squishy, flexible ranges, but something like 10 to 20 or 25% of the company. Now, obviously, you can't give up 25% of the company through 5 rounds because there won't be any company left for you, right? So it would be on the lower end of that if you're doing fewer financing. So you might give up, say, 10 or 12 or 13.6 or something, right, in your first round. And then another 10 or 12 or 15 in the next round, that kind of idea. And it's important to note that in venture capital, you don't sell your stock, right? You issue new stock to investors. So to keep it super simple, if you were a solo founder and you had 100 shares and you owned the whole company, and somebody wanted to come in and contribute, say, $1 million, you would not give them part of your shares. Like you wouldn't give them 10 of your shares for $1 million and then you own 90 and they own 10%. You actually issue $1 million worth of new shares. So now there's going to be just very roughly something like 110 or 112 shares on top. You still own your 100 and they would own their 10 or 12, which would then represent about 10% of the company for $1 million, which would essentially be a $10 million valuation. So it's important to think about that, because what's happening is that venture capital is, you don't take one pie and split it up into smaller and smaller pieces for each person. That's all owned by the founder. You actually make the pie a little bit bigger each time by adding more pie to it, if that makes sense. So it's hard to get your head around. I remember that confused me a lot when I raised my first venture capital round, because that's what they talk about, why they talk about dilution. Dilution, you're adding more and more pie, essentially, so that the shares that you do own are actually a little bit less of the company each time, even though you own the same number of shares. That's the key. So yeah, hopefully that's helpful. And the range is, like I said, 10, 15, 20% per round. And hopefully you don't give up more than 60 or 70% of the company after several rounds, to the point where you get to lift off, where the company's really doing well and starting to make a lot of money and hopefully profitable. And at that point, your company can hopefully get acquired or go public because it's spinning off a lot of money. And then you might be down to, say, 40 or even 20% of the company, but now you own 20% of a company that's worth, say, like $500 million or $1 billion. So 20% of $1 billion company is $200 million, right? It's better to have that 20% of something huge than 90 or 100% of something small. That's the whole logic of Silicon Valley. So if that's useful to you, let me know. Let's see. Jules says that's helpful. Okay, great. I'm glad. That's something that people don't talk about much. I don't know why. It's a fundamental premise in Silicon Valley, and it's like so basic they never say it, at least in my experience. So hopefully that's helpful to you guys. All right, let's keep going. Let's scroll down. Let me just see who else said what, and let me know where you guys are from again. The rest of you here, I see we've got several dozen of you here. Okay, so we did hello to Ashley in New York, and Suresh in Bangalore, and Nelson in Vancouver, and Jules. I'm still wondering where MKE is. MK, does anybody else know MKE? MKE. That doesn't ring any bells. Fremont, Tomar's in Fremont. That's in California. And let's see, OG from Chicago, and Samantha from Newport Beach. That's right near here in Southern California. Shreyas from Pune. That's in India. Hello, Shreyas. And Cliverity from Fullerton. That's also near here. Okay, here's a question. Ashley says, when is the best time to start raising finances? Well, yesterday. You want to be ahead of when you need the money. So the best time to start raising money is well before you need it, because you're out there building relationships. So raising venture capital is not like getting a car loan, for example. A car loan, you go to a commercial bank, you walk in and you say, I have a credit score of some 720 and I have a good job with this much money and I have this much money in the bank, and therefore I want to borrow $40,000 for a car. And they will run those numbers, and pretty much right there, they'll say, okay, you're good. We'll give you a loan at this rate and these terms and blah, blah, blah. And it's kind of a one-off transactional. You don't need to have a relationship with that banker. Venture capital is not that way. Venture capital is much more complex and based largely on, as you know, the metrics of your business and the potential of the growth and the pitch you do and the pitch deck and the projections and all that stuff. But also it's based on the relationships. So if you know someone, they're going to believe all those assumptions that are compounded in your financial projections much better. They're going to believe you, that you're going to do it, that what you say what you're going to do. They're going to believe that you can sell to customers. They're going to believe that you can recruit a team. They're going to believe that you've got a handle on this domain because you're some sort of expert from your previous experience. All that belief requires a relationship. So this is right where things get sticky, especially say for minority folks or people who grew up not in Palo Alto, right? If you're from somewhere else, or even if you're a woman, right, that don't have traditional access to these circles. So they don't naturally believe you as well, which sucks, right? Which is one of the reasons I do this, to try to help everybody get on the same page about how this works. So the answer to your question is, when is the best time? The best time is yesterday, is last year, 2 years ago, right? As soon as you can, in other words. You want to get out and start meeting investors for a couple of reasons. The first is very much what I said. You want to build the relationship so that when you are ready to ask for money, you don't walk in and say, I would like to raise $500,000 from you for the seed round of my company. And they say, who are you? Why should we believe you, right? You already have a relationship, and you call up your old friend who you've had lunch with 3 times in the last year and you see occasionally at events, and you say, hey, you know that thing I've been telling you about? It's ready. You're going to love it. And yeah, we are going to be raising some money, but we can talk about that once I show you the demo and it's super cool and you're very impressed, right? That's the kind of vibe you want to do. If you just start spraying out your pitch, you're going to be up against people who have already done that, right? So you need to have those relationships going. And that is really what the competition looks like, I guess. That's why I'm saying yesterday, if you can. So not trying to stress you out. I'm just saying this is not just purely a pitch and win sort of game, right? This is not a game show. It's not a bank car loan type conversation. This is a relationship. So the sooner you can get out there, the better. And we can talk about how to do that if you'd like. But I wouldn't wait, is what I'm saying. Even if you're not ready, you want to be out making friends with people, making good impressions to the point where they will listen to you when it's time for you to actually ask. All right, let's see. Sammy says, anyone in Australia? Usually, Sammy, we have We have a lot of Australians here. It's one of the other reasons I do this at night my time, so we can hit Australia in the morning there. Depends on whether you're in Sydney or Perth, though, I guess, by a couple hours. Sammy fights to get government grants to entrepreneurs. I do it for free. Excellent. Well, thank you, Sammy. That's a great service. How much of the, okay, so here's John clarifying his question. How much of the business idea should be shared in joining an angel financing director? John, I'm sorry, you're typing too fast, man. In joining an angel financing directory, I think you mean. Okay, there, I think I got it. Okay, how much of your idea should you share when you list your company online, is what you're saying, in a startup funding directory, right? Like our startup investors directory, or on Startup Council, right? So hold on, I'm looking for this. We have this. Maybe this is what you were talking about, because I think you've been here before, right? The Startup Investors Directory. This is a directory we put together, and you can see a special promo code there if you want to join cheap. But that's a directory of 3,000 early stage angel investors, right? Or all kinds of investors, not just angels, sorry. So what John is asking, now I got it, John. Sorry, I'm a little slow tonight, is if you come here, for example, right? And you put your business, your listing here, so that that's my business card, right? So that people can come and find your business and like say, I'm an aerospace investor and I'm looking for aerospace hardware startups. So I'm online searching around, and John would want to have his directory somewhere so that that investor can find him, right? Because otherwise, if you're only on your own website, you're limiting your reach. You want to make sure that your company is listed so that it shows up in search engine results, the old-fashioned SEO, but also these days so that it gets absorbed into ChatGPT and Gemini and Claude and Grok and everything, right? So that it shows up in AI summaries as well. So you need to have multiple touch points out there on the internet. And that's one of the big services we provide at startupcouncil.org. It's a membership directory. It's like a phone book, right? So what John's asking, how much of his business idea should he share when he has joined startupcouncil.org and he puts up his listing? We have the ability for you to fill out multiple pages of a profile about your company so that you can explain, what it does and who you are and why you're doing it. And you can share financial projections or your pitch deck, like all that stuff, right? So that's all context for why he's asking. So the answer, I would say, and by the way, I want you guys to answer too. I don't have all the answers here. Would love to hear from all of you. I know there's plenty of expertise on these calls, and it's not all between these ears. It's out there too. But my answer, John, would be you should share enough of the business idea so that people believe you and are interested, and probably not a whole lot more if it's something that other people can copy. At the same time, I would balance that against the idea that you don't really need to worry too much about people copying you unless it's something dead simple. Because nobody's going to choose to do it or do it as well as you do it because you chose to do it, right? So if like I said, continuing with the same example I had, if you're doing a hardware startup for aerospace, well, that's probably because you are a pilot or you are an aircraft mechanic or you know something about aerospace that you saw a need and you had an idea that, convinced you to quit your job and start pursuing this, right? So even if you gave me 110% of all your thoughts and plans and dreams and business plans and models and gave them to me or to some of the other people on our call, we wouldn't execute it the same as you because we don't know and we don't care like you do. So I wouldn't worry too much about over disclosing unless it's really simple, like something you're patentable that people could just rip off and manufacture, by the zillions. Generally, your problem is more about getting people's attention and getting them interested than it is about people stealing your idea. So I would put as much out there as you think you can afford that is attractive, interesting, and maybe even provocative, that attracts attention. That's the game these days. It's not about keeping your idea so that nobody can know what it is so they don't rip you off. The game is getting it out there so that somebody gives a damn can find you. That's really your challenge. It's not maintaining ownership or control. It's getting attention at all. That's the real challenge. And that's why we started the Startup Council directory, because I want to help founders be found, essentially, right? You can't be a founder without being found. You can't be a founder if you can't be found. That's good. I'm going to put that in my next book. But the idea is really that attention is more important than control or or ownership, because nobody would do it the way you do it. Okay, I'm repeating myself. So I hope that was helpful. Pretty vague, right? Because I don't know exactly what you're working on. All right, I'm going along here. Let me put up the, let's put up the chat here in case anybody wants to come join me. Anybody want to talk on camera? We could do that. Be a little more interesting than me talking to myself, but I appreciate all you listening here. Let's, let me keep looking at the chat here. Okay, Jules, Alan's in Vancouver. Annyeonghaseyo, Alan. Looks like you're Korean. And Milwaukee, Suresh. We have Silicon Valley investors here in Milwaukee, says Jules. For some, oh, that's what MKE meant, Milwaukee. Okay, thank you. Got it, Jules. Now I understand. For Summerfest Tech AI 20. Oh, that sounds cool. I didn't know about that one. I might have showed up for that. Very cool. Well, I'm sure it's beautiful in Milwaukee this time of year. And let's see. Dooley says, from Irvine, hey, Dooley, I'd love to pitch my startup box next showing. What do you reckon the best way I can do that for the next show? Well, next time, come write down this URL that's on the screen right now. And the best way is to come and join the Startup Council. That way you'll get the emails. And if you're a member, you'll get priority. And we will make sure you get on the show. I'm trying to find the right, here, try that one. Yeah. So join us, and then we will give you priority for these shows. And we're going to be doing a lot more of these shows, by the way. It's summertime, so I'm going a little slow, and I'm working on this new book. But once I get this book done and the summer's over, we're going to be doing a lot more of these at different time slots as well. So those of you, like right now, we don't really serve Europe very well because it's the middle of the night there, right? Or even the East Coast of the United States. So we'll be doing some back in the daytime like I used to do. I've been doing these at this slot more for a nighttime in California here, but also for Australia, East Asia, South Asia, and Australia, right? So we've got a lot of folks from there. And welcome to all of you. Okay, next. How can I value my startup company myself at an early stage? Yeah, that's a great question, Alan, and it's a tough one. The valuation game is hard. I would need to know a little more, but let me, like, are you a software company? Are you a hardware company? Are you, consumer goods, or how far along are you? All that kind of stuff. So you can come up with a number. But here's the honest truth: it's a negotiation. There's no proper amount. If you had, for example, a specific amount of revenue, whatever you had, $10,000 a month or $1 million a year, even then there would be a negotiation, because the value of a company is really, in theory, the net present value of all its future cash flows, which means basically how long are you going to be making a profit into the future, and then discount that back by current interest rates to come to a number. So both of those require seeing into the future in ways that nobody really can. So it's a negotiation. The numbers are made up. So the bottom line is most first rounds are done with a valuation of $2 to $4 million. That's it. Pick a number. 2.5 million, and we're going to give you $250,000, so we want 10%, something like that. And it won't become real until you actually have revenues and other investors will come in, and once you have enough numbers to actually calculate some real things, then people can agree and argue and negotiate, but at least based on some goalposts, right? Right now, it's completely made up. And the earliest investors, like myself as an angel investor, when you come into a company like that, you have to be prepared to lose all the money. So it doesn't even matter in some ways. I know it sounds funny, but the price doesn't matter so much as long as it's low, right? You can't say it's worth $1 billion, because then, that's just silly, and nobody will make any money if you do that. But if it's a reasonable number, 2 million, 3 million, something like that, and I get a decent percentage for my money of 10, 15, 25%, something like that, like we said, that gives me enough to grow with you. And then it's because you're going to do the work, right? I'm just putting in the money. So I'm counting on you to then grow that pie, like we talked about earlier. And the next round, or the next round, is when the numbers get more real, but I already have a good chunk of it. And my chunk will be smaller as a part of the pie overall, like we talked about. But that chunk will be increasingly, the chunk will be increasingly valuable because the pie as a whole has gotten so much larger, right? So short version, $2 to $4 million. It's a negotiation, mostly made up. Depends on leverage on both sides and how much cash they're putting in, and of course, how much you need the cash. So there's an answer. And again, anybody in the chat room that agrees, disagrees, has a better answer, please chime in. I'm not trying to lecture here. I'd be happy to hear from as many of you who want to contribute as you'd like. Okay, next up. Yeah, this is a good one. Okay, so if we don't have a circle to find VCs, what is the best way to find investors? I'm thinking about submitting to an incubator like Evo, Nexus, and Irvine for an app that's 90% done. Yes. Okay, great question. Very common question and a legitimate question. Okay, well, there's a couple ways to do this. One, of course, is you can do it online, and you research the hell out of everybody, and you find people who are as close to your ideal investor as possible. And these days, there are hundreds of thousands of investors in the venture space. So even if you're doing something very, very niche, there might be someone that's interested in that. And if you can get someone who's made money in that niche before, then they're very likely to be interested in you, at least as a mentor. And mentors often lead to investment anyway. So that's one thing I would do. That's a research angle. The other is I would be going to events. I would build your own circle. Yeah, that's what you need to do. You're going to need to do it eventually anyway. So you might as well get started, like we said at the top of the show, meeting as many people as you can, not necessarily just investors, but also attorneys and accountants and especially other founders, because every other founder is on the same journey, right? And you guys can trade contacts, especially if you're in different fields. Like if you're a software person and they're in biotech or something, you'll both be meeting investors, but your biotech investors aren't going to invest in their software company and vice versa. So you can trade the people you meet that don't fit for you, right? So build that network is honestly the best answer, because those personal contacts are great. Now, an incubator or an accelerator like Evo Nexus or many others, those can be super helpful. In fact, that's the primary benefit of being involved with a lot of accelerators, is you get kind of a credibility stamp that you have passed some screening, right? And that you're reasonably intelligent and can do a reasonable pitch, and you have something going on, basically. It's kind of a validation that you are credible, even if you may not have raised a bunch of money or already had a bunch of profits or something, right? So that is worth it. And then, yes, of course, the network that they introduce you to, it can be really valuable. Just a tip on that, though, I would be careful in terms of, well, obviously, how much are they asking? I'm not picking on Evo Nexus. They're good friends of mine, and Bob and the team over there are great folks. But just more in general, at a 30,000 foot, strategic view for everyone around the world who's listening and thinking about incubators and accelerators, look at, of course, the terms of the deal. They're taking some percentage, they're giving you some money, maybe they're giving you some office space, they're giving you access to resources or people, something, like the better you understand that is to your advantage. And then I would be careful about who they claim to know, because I've seen many lists of contacts, and some of them are quite old, right? So just, I would be a little careful. If they say, we know all these people, well, do you know them, or they actually invested? And when was that? If it was $10,000 in 2011, probably not so relevant, right? If it was $1 million last month, okay, cool, let's go. But in between, there's a lot of gray area, and I think this is a long way of saying references. Check references before you sign a deal, for every deal, including that with an incubator or an accelerator. And even if you don't join a specific program, those sorts of facilities often run programs. For example, here in Irvine, our friends at Evo Nexus, every Thursday night, they have a great AI salon or meetup or something. I'm not sure what you'd call it, but they have a different speaker every Thursday on different AI topics, and they're getting really good feedback on that. So even if you don't officially join, you can certainly go hang out at a lot of the accelerators and incubators, because they have a lot of people in the same place with similar interests, and that's a great place to make friends and contacts. All right. Dooley says, okay, I'd like to pitch next time. Okay. Best way that you recommend to prepare and get on the show? Well, practice your pitch. It's 2 minutes only, right? So we're not trying to, don't want your whole life story, just 2 minutes. Is usually enough to get to the point. And that is kind of the point, in fact, is to get you to get to the point. A lot of founders have a beautiful 10-minute or even 20-minute presentation deck. But when you try to get them to summarize down to say 90 seconds or 3 minutes or something, like for a pitch competition, they have real trouble. And it takes practice. It takes anybody practice to do that. So practicing your summarization would be great. And then you might also go back onto YouTube and look at old episodes of this show. I've been doing this for years, and there are many, many hours of me talking, if that's helpful to you. Lots and lots of tips that could be used to help you polish your pitch as well, if that would be useful. All right. What do we got here? Yeah, speaking of that, actually, before we get to Samantha here, let me, man, this is being wonky tonight. Okay, I guess I won't do that. I guess I would just ask you all to like and subscribe and comment if you're doing this. I was going to put up the banner to say that, but it won't click. Okay, but likes and subscribes are what let us keep doing this, right? This is free, but it lets me help more people. And I can't talk to all of you one-on-one. There's just not enough hours in the day. So that's why I write books and I broadcast like this. So if you think this is helpful, please like and subscribe, and God forbid you could leave a comment, right? Because that drives all those algorithms. You guys know the same stuff that you watch. And we're mostly active on LinkedIn and YouTube. So that would be really helpful if you could like or subscribe or leave a comment. And actually, follow-up questions are fair game too. If you think of something later, you can put a question on the replay that will show up on YouTube, and we'll be happy to help you out there too. Okay, Samantha, we have a HAS native AI product ready to go. We've invested $20,000. We're looking for another $30,000 to create 30 more hardware units for major proof of concept. We have a buyer wait list. Should we raise? If so, how? Well, first of all, congratulations. That's wonderful. Good job. And you're ready to go. That's got to be very exciting. I'm not sure what HAS is. Maybe hardware as a service? Yeah, I'm guessing that's what it is, because you're trying to create hardware units. Okay. So, and you put in 20K and we're looking at another 30K. Okay. So Samantha, you're in a bad place, unfortunately. I think you know this. $30,000 is not enough for investors to get excited. It's just not enough money. It's not worth the trouble, unless it's like your uncle, right? Or your aunt or your grandma or somebody, your brother-in-law. $30,000. This is one of my big pet peeves with the venture capital industry. And it's one of the reasons I write these books and when I do this show. A lot of people who are VCs, they come from money. So they will tell you, oh, you need $30,000? Well, just borrow it. Just put it on your credit card. Just get it from your mom, that kind of stuff. A lot of people don't have that kind of money, and they don't have friends or family with that kind of money either. I certainly didn't when I started. That's exactly why I do this, because most people don't have that kind of financial network. Unfortunately, the financial world doesn't care, and they're going to expect you to float that yourself. So 20K is great. So why not do another 30? That's going to be the answer you're going to get, unless you can find, like I said, your aunt or a cousin or somebody, a friend from high school, whatever, somebody who really believes in you and already knows and likes and understands and gives you the benefit of the doubt, and has an extra 30 grand that they're ready to lose. That's a tall order. I'm not sure you'd want to do that with friends or family anyway, but investors are not going to bite at 30 grand unless you find somebody specifically who is into hardware as a service or knows AI or really understands the pain you're talking about and the solution you're providing. So my recommendation would be look at your credit cards, or if you're really into it, sell your car, or something, make it happen yourself. Although I'm not recommending that, but that's how most people would fund 30 grand. Just as a quick example, my first company, and I'm not recommending this, I was over $100,000 in debt on my credit cards. And this is 25 years ago. So 100 grand was like 300 grand now probably. And that was really stupid, but I was committed, and that's how you make it happen. Right. And it didn't happen in that case, but I built myself up through other successes, obviously. So, that's the kind of commitment that investors are going to be looking for, unfortunately. So I don't have a good answer for you, a happy answer. I think the answers are correct, but so either figure it out, bootstrap it, or find a friend, family, or someone who really cares already, or figure out a different way to do it. Like, do you really need 30? Could you just do one hardware unit, just for the proof of concept, or 5 instead of 30, right? I mean, I think you need to re-examine your goalposts. There's no one sitting around waiting to write a $30,000 check that I know of. It's too small. Okay. So sorry. Okay, moving along. And again, by the way, that's a perfect one. Other people chime in there and tell me where I'm wrong, right? If you have ideas where she could get it, please chime in. I guess I should say, for example, there are grants, right? You know, maybe you could get a small business innovation research grant if there was a military application, or maybe there's a lot of pitch competitions, right, where you could win 30 grand, right? Maybe you go that way. There's other ways to do this. So I'm not trying to be discouraging. I'm trying to be factual but supportive. All right. Ashley says, perfect answers. Okay, well, thank you, Ashley. I'm pivoting my travel business model. I started in Africa and intend to come to Silicon Valley in August of the week to explore and learn more there. Well, awesome. That sounds great. That's not so much a question, Ashley, but that sounds fantastic. Good for you. Yeah, I think you should do that. You know, the book I'm working on is about fundraising. And one of my points in the book is that you just can't underestimate how much higher the density of talent and the velocity of information is in the Bay Area. It's just, there's just so many more people focused on this stuff. It just spins way faster. And I think a visit to the Bay Area would be good for you, Ashley, if you can afford that financially and you have the time. I think it'd be great. Great idea. Sonny says, I have all my pitch decks, financials, and the story. I have the platform built. I waited too long for funding, though. Although it runs on very little cost. I'm the designer, engineer, and marketer. Okay. I'm not sure what the question is, Sonny, but that sounds exciting. Sounds like you need to hit the pavement and put all that material to work. Okay. Tomar says, should we raise before finding a customer? I was planning to get some customers in a SaaS product. Okay. No, Tomar, I mean, there's 1,000 different ways to do this, right? There's no right or wrong answer. It depends on your situation and the products and timing and a lot of luck. But I wouldn't raise money at all if you don't have to. The media makes it sound like venture capital is like the only way to do this. And it really, really isn't. You can run it on your credit cards, like I was just talking about, or you could bootstrap it, or even better, if you think you can find customers, run it on revenues. God forbid, you could actually build a business based on revenues. That's what everybody did for thousands of years before the banking system existed, right? If you can just make something for $10 and sell it for 25 and reinvest that 15 and do that again and again and again, you don't need investors, man. And you could end up owning 100% of a real business. Maybe it's only a $10 million business, but that's 10 million that you get every year. You're doing all right, brother. I wouldn't sneeze at that at all. If you really want to do venture capital, then you could raise money, sure. So then it isn't maybe a $10 million a year business, a $100 million or $1 billion business. And then again, your piece of that pie is now you've got whatever, $200 million. Good for you. Absolutely. That is more, 200 is more than 10 for sure. But you've given up some control, you're on a certain kind of growth path. But if that's what you want to do, absolutely. But even then, I wouldn't raise until you're sure you want to raise, because you'll get a much better price if you already have customers. To be honest, I don't know that anybody's going to invest in you anyway if you don't have a customer. So I think your assumption there might be wrong. I'm giving you the benefit of the doubt that you could do that. But in most cases, nobody's going to invest anymore without customers. That did happen occasionally in previous years when things were just so frothy in the market. But these days, people want customers and revenues and some proof of traction and validation before they'll invest at all. So I'm not sure you even could raise before finding a customer. But if you could, even if you could, I'm not sure you should. So I hope that's helpful. All right. My goodness. Okay. So a lot of questions in the chat room. Got to be careful what I wish for. Should I raise? Oh, we did that one. Okay. How should I focus my attention? Sunny's back. Okay. It's my first time raising as a solo founder. Where do I go? Okay. So this is Sunny, who was here a minute ago, who said he had all his pitch decks, financials, and the stories, the platform built, and it runs very little costs, but he's going to start looking for funding, but he may have waited too long. And he is a solopreneur, both the designer, engineer, and the marketer. Okay, so where do I go? Well, again, it depends. I don't know what kind of business you're talking about, but the fact that you're doing all those things, Sonny, the first question most investors are going to have is, what kind of validation do you have? And by validation, I mean two things. One is, do you have any customers? And the second is, do you have any teammates? Like most incubators or accelerators do not admit solo founders because they want validation too. And the validation in both cases, what we're looking for as investors is, does anybody other than you care, right? Have you talked to any customers? Do they, ideally you have some customers, or at least you have a waiting list or something quantifiable. I talked to 100 people and 87% of them were wildly interested. 6 were already with a competitor and 3 thought I was nuts. Fine. But you had that 87%, right? I mean, that's a high number, but quantifiable numbers that demonstrate validation that isn't just from you or from your mom, right? That's what we're looking for. And similarly, in terms of a team, if you are the designer, the engineer, and the marketer, who else is there? That it's understandable. You sound like a really bright, talented person, but investors want to know that you can also recruit a team, because if this is going to become a big company, Sonny can't do everything, no matter how smart he is. There's just not enough hours in the day. So what have you shown in terms of customers or human resources that other people are interested, that this is a good idea, and that Sonny is the guy to make it happen, or gal? I think you're a guy, looks like, from that tiny picture. So that's what I would be worried about. I would get that together, figure out what your answers are to those questions. And then I would be looking at, I have this idea that you were in Hawaii. Was that right? I think you wrote in, right? Because I don't know the market too much in Hawaii. Sorry, I'm looking at the printouts here, the people that had emailed me beforehand. I appreciate it when you guys, yeah, you're in Honolulu, right? I got you. Yeah. Okay, so I don't know the Honolulu market much, but you are in the United States. So I would look for the SBDC, Small Business Development Corporation, SBDC. That's a U.S. government funded, meaning your and my tax dollars, resource that helps consult early stage businesses. And oftentimes they will have somebody who knows something about internet businesses, and they could help you figure out what to do, basically. And are there local angel groups or places where you could practice pitch competitions, maybe at the University of Hawaii or whatever? There are clubs or things like that you could get involved in, because again, you want to build some relationships and learn the language of investors so that you can speak to them in their own language. They'll trust you faster, and then maybe raise that money you were hoping for. So hope that was helpful. Okay. Jules from Milwaukee. Many founders here in the Midwest are nervous to meet with Silicon investors due to ideas IP being taken. What advice do I have? Get over it. 100% get over it. Silicon Valley investors are not going to take your idea unless they're scumbags, but there are scumbags everywhere, right? There's, if anything, I would say a lower proportion in the venture capital industry, because it's all reputation based. We cannot afford to rip off ideas. If you're really an investor, the last thing I want to do is steal your idea. I'm busy. I don't have time to go build your idea. I'm busy with my investments, right? I'm busy doing stuff like this, right? Or I'm rich. I'm playing golf, right? I'm not looking to rip off your idea. This is way overblown. And I addressed this a few minutes ago in a different context, but worrying about people stealing your idea is naive, I guess. I don't want to say it's nothing, because it's a thing, but nobody's going to take your idea and build it. If it's that simple, then somebody's going to come up with it soon separately anyway. The way that businesses differentiate themselves is by building. If you build it and make it happen and grow the team and grow the revenues, then the investors will come to you. We're not investors. Real investors are not out there looking for ideas to steal. That's not their job. Venture capitalists have a job. They're entrepreneurs also. A venture capitalist raises money. Like if a VC says, I have a $100 million fund, that's 99% of the time, that's not their money. It's money that they raised from big asset managers like insurance companies and pension funds and endowments and universities. And they raised that $100 million. And now their job is, in the next 5 to 8 years, to invest that $100 million and turn it into $1 billion. That's a big job. So from a founder's point of view, it may look like they're just sitting back fat and happy, right? And they're just kind of picking and choosing and harassing founders, belittling their ideas and picking 1 or 2 winners. but that's because they're hustling their butts off because they have to pick one or two that survive the 90 other ones that die and lose their money, right? Because that $100 million fund, say they might invest it in 50 different companies at 2 million each, and 45 of them are just going to vaporize. And those 2 or 3 that are left are hopefully going to be an Uber or a Facebook or a SpaceX that go to the moon and they repay the whole other thing. It's a very risky job. And anyway, they don't want your idea. They don't care. That's not what they're doing. So I think that's an overblown concern. It's the same idea. People want VCs to sign a non-disclosure agreement. We will not sign non-disclosure agreements. We can't. We see too many ideas, right? But if I wouldn't disclose too much to someone who you don't know, if there really is something proprietary, sure. You can have a version of the deck that is interesting and provocative, but doesn't give away the secret sauce. You can even have like 2 or 3 levels, and you don't really tell them really what's happening until you really know them. That's perfectly legit and is done all the time. But I would not avoid meetings or avoid building relationships because you're scared. That's amateur hour. You're not going to get anywhere, right? Your problem is not. I said this earlier, right? Your problem is not. Your problem is not people stealing your ideas. It's being recognized for being found at all, right? You need attention more than you need privacy. Okay, so all right. I hope that was helpful. And if you disagree, that would be fine. Okay, this is Julia Ferrara from Detroit Homecoming. Oh, okay. All right. Well, nice to see you. I hope that you're well. I hope that was helpful. You're welcome to disagree, like I said. But thank you for highlighting this issue because it's an interesting one, and it comes up over and over again. I don't know where founders get this idea that investors are going to steal their stuff. It's just not a thing. Cool. So then still going here. And thank you for being here, Jules. We're going to be doing a lot more with the Detroit Startup Council coming soon, by the way. Okay, common red flags investors see in first-time founders raising capital. Okay, that's a good general one there from OG in Chicago. Common red flags. Well, we've covered a few of them already. You can hear some themes, right? Don't ask me to sign an NDA. Don't be overly protective of what you're doing, because if I don't understand what you're doing, how can I possibly invest? We'll start with those two. Crazy projections, right? We're going to make $100,000 in the first year, and then $200,000 in the second year, and in the third year we're going to make 50 million. Like that? How is that? That's not even physically possible, right? We know the numbers are made up, but they can't just be complete science fiction, right? Founders who won't listen, founders who have no teammates or no demonstrated validation, like I was saying a few minutes ago, no validation from customers or teammates. They haven't convinced anybody other than themselves that this is a good idea. We're not going to invest in that. The job of a founder is to find and build coalitions of customers and teammates, right? And if you're not doing that, then it's not a business, right? I'm going to write that one down too. Build coalitions. That's good. The other one, I think probably the first one, actually, this is a great segue. Thank you for asking. I've been doing some webinars. I work with the State Department quite often to do webinars for other countries to help entrepreneurs in other countries learn how to raise money in Silicon Valley. And I was doing one in Pakistan in the middle of the night last week. And it was the middle of the night, really the middle of the night for me. But I realized we needed a takeaway. So I put together this fundraising tips, and I can show you. I literally just finished this today. There it is. This is the first ever viewing. And if you zoom in really close, you can read it maybe. But anyway, those are tips about things that you should and should not do. So just what you're talking about there, OG. And you can have this. It's on the startupcouncil.org website. And I even have this. So if that looks fun to you, you can scan. Let's try this. Can anybody scan this? I was thinking that this. Can you scan a QR code when I just put it up here on YouTube like this? Because this will take you to the page on startupcouncil.org. So I don't know if anybody cares, but if you want to download this, you go to the startupcouncil.org, and it doesn't quite fit. It says tips, TIPS, because it's investor tips. So if this doesn't work, startupcouncil.org/TIPS tips. And that would be, you could get that sheet, and that would give you some other ones that will all be in my new book, of course. And if that's helpful, I would love to hear about it from you. There, I wrote tips on it. Okay, so like that, tips. All right, so if anybody can do that, that QR code, I'd be very curious. Oh, just scanned. Okay, great. So somebody did. OG did. Okay, great, awesome. Okay, well, hopefully that's helpful. Like I'm writing a whole book about this because there's a lot, but that's a few of the basic ones anyway that I think are important, and we can talk through them more later if you'd like. Okay. Daniel says he just submitted the question via the website form. Okay, well, we can try to do that next time, Daniel. That would be July, I don't know, what is it, 30th or something, I think. Boutique says hi. It's going on until Friday, and we need more Detroit representation. What is? Oh, you're the AI thing in Milwaukee? Oh, that's awesome. I'm in California, though, so I don't think I'll be there. But anybody that's in Detroit, any of our Detroit friends, please go over to Milwaukee. Jules is love to see you. Okay, so then here, right, then we were off the air for a while, and then, okay, transmission is out. There it is. Okay, so here's what she's saying. Summerfest Tech. A lot of Western Michigan representation, but trying to get the 313 folks. That's the 313 is the area code for Detroit, for those of you who don't know. So if you're in Michigan and up for a trip to Milwaukee, go see it. All right. What are the most common? Did we just do this? Yeah, okay, we just did that, OG. Okay, hardware as a service, yes. Android mobile. Okay. Okay. What kind of numbers would be reasonable enough to work with? And how do you tackle the difficult question I hear about how different is your business from competitors? The first question, Ashley, I don't know what kind of numbers you're talking about, so I can't really address that. But how do you tackle the difficult question about how different is your business from competitors? Yeah, that's a great question, and a common one, as you're saying, and it's threatening, right? Let me put it this way. There's no way to tackle it except head on. You have to be honest, and you have to be honest with yourself, because there's always more competition than you want to admit. As a founder, you fall in love with your baby, right? The creation, the product, the service, the team. You're in love with this, and you can't bear to think that it isn't unique and going to just change the world for the better as soon as you have enough capital to get there, right? Of course, you believe that. Investors, though, we have a wider perspective, and a common problem, this is back to something that OG was asking, a common red flag is we'll ask about competition, and I got to tell you, it's not 100%, but probably 60%. I mean, it's a majority of founders will say we have no competition, or at least they used to. Things have gotten better, but that's just ridiculous, because everybody has competition. If you have no competition, that either means that there's not a market that's going to pay for this, so no one else tried, or what you're doing is so complex that it pulls together a lot of different angles from different markets. And yeah, it would be really elegant, but it is going to be impossible to sell and bill, right? Because you're pulling efficiencies across departments and across budgets and maybe across companies or languages or time zones, or you're doing something that is really cool and elegant and would be super cool, but it's never going to happen. And there you might have no competition. Anybody else has competition. Absolutely, they have competition. And even if they don't have competition that, for example, is AI driven and software based and runs on your phone in the cloud with magic pixie dust, there is some competition that exists in the real world that people are getting this done already. And that's actually what you're selling against. Founders get caught up in the tech world a lot of time, at least in my space. I'm mostly a software guy, but we get caught up in the tech world and think everything has to be software. And the fact is, a lot of businesses still run, like on fax machines, right? And investors want to hear about the real competition, not just like what you deem as your technical competition, but the competition that is the alternative solution that people are going to have to be talked out of in order to buy your solution. And they're going to have to be retrained and their budgets reallocated to you from some existing paradigm. And that is the real competition. And that is rarely well explained, in my experience, by founders. So you could get farther faster with that question, answering that question, Ashley, if you can say concisely, right? Much more quickly than I just did. But existing solutions are A, B, C. They cost this much per year, but the problem is X, Y, and Z. And we are better because of A, B, C, and D. And we're cheaper because of E, F, and G. And we think we can sell this through to these kind of customers in an average of 3 weeks for an average budget size of $100,000 or something like that. That's the way investors like to hear people speak, is in equations. So if you can come up with something like that, that'll get you through the competition discussion, I think, in flying form. Okay. Next up, Samantha's back. We appreciate the realistic answer. Oh, this is in regards to the $30,000. Yeah, sorry. Again, you could certainly try, right? See if your aunt will go for it, But she says, we will bootstrap credit card it. Haha, I see your point, and we will float a 5 to 10 proof of concept instead, and then raise and give a percentage or use MRR to keep growing. Solid guidance. Okay, good. Well, thank you. I'm glad you took that in the spirit which was intended. It's a fact of life, right? If you've got 30 grand, investors don't want to see you bankrupt yourself because we want you to succeed, right? But we do want to see you have a lot of skin in the game. And I've seen this many times. Like, we'll see somebody come in and they'll pitch and they'll say, we're raising whatever, $100,000 or something, or $500,000. And because I belong to some angel groups, right? And those will be like 30 or 50 of us sitting in a room all listening to this presentation. And then when the person's done and they leave, we all talk about it, right? Like, what did you think? What do you think of the way they answered that question? Or what do you think about the competition? And somebody will say, I don't know why this person thinks they need 500 grand. I happen to know their dad, and that family's worth $1 billion. So, and everybody go, oh, gross. So you got to do the best you can on your own, and your contribution should be proportional to your resources, is what I'm trying to say. And if you and like I said to Tomar, I think, or Itamar earlier, don't raise money if you don't have to. You'll be in a better position later when you do raise money. All right. Marie says, let's always do a lot of good. Well, I'm down for that. Excellent. Okay. Mankoba. Hey, South Africa. Excellent. Nice to see you. I help grow startups using techniques made for projects to reach commercial success. My main role is getting investors. How can I reach Silicon Valley investors? Well, let's see. To do that from South Africa, well, I would you would want to think industry specific. So are you talking about software investors or medical device investors or aerospace or hardware or consumer products? Like, each of those is a separate thing, right? And each of those has their own network and their own clubs and associations and conferences and online events. So I think you'd want to pick whatever cluster is the most applicable to your work with entrepreneurs there in South Africa. Silicon Valley investor is like saying, I want to reach people, right? And there's lots of different kinds of people. So I would start with identifying your ideal investor profile. And then I would look at, assuming you can't fly over to the Bay Area, right? I'm thinking remote. You would probably want to go attend events and try to get to know people, essentially. And you could send cold emails. Those work sometimes, but you really need to spend some time on LinkedIn and get to figure out what those people are about, what they're investing in, maybe something you have in common that you could use as a conversation starter. This is also going to be in my new book. So I guess and then organizations. I would look at, like, in South Africa, for example, I'm part of an organization called the Global Entrepreneurship Network. I'm looking around to see if I can find something with their logo on it. Oh yeah, here's a little badge. It's pretty small. What is this from? Well, can you see this logo? There. That's that. Oop. There. That circle there is the Global Entrepreneurship Congress logo. That's from their conference in Australia I went to a couple of years ago. But they have chapters all over the world, and I know they're very active in South Africa, for example. So GEN, I think they're at, it's not gen.org. It's a very short URL. I can't remember what it is right off the bat, but Global Entrepreneurship Network I would look at. I would look at Startup Grind is another organization I used to be involved in that is global. Our Startup Council, like as you've heard about a couple times here, this one behind me, Startup Council, we have people all over the world. We even have a meetup group, I think, in Johannesburg. I don't know what city you're in, but you come and join us. You just got to get yourself into those circles so that you can meet those people and build relationships. That's the answer. And LinkedIn could be really good for that as well. Samar says, great to see you again. Yeah, hi, Samar. Trying to see your picture. You're from Detroit, right? Didn't we met in Detroit? What's the most attractive category of businesses for investors? Well, AI B2B SaaS. Yeah, that's right. Well, that's the joke these days in venture capital circles is, what do you invest in? Oh, I'm agnostic. I invest in anything, which means B2B SaaS. AI B2B SaaS, exactly, right? So no, angel investors may be agnostic enough to look at anything. Opportunistic might be a better word, right? So if you're writing your own checks like I do, I'm reasonably opportunistic. But even then, I have things that I specialize in because some things I know about and some things I don't. I used to invest in med tech, and all I did was lose money. So now I don't do any med tech. I don't touch it, right? If I'm going to do medical stuff, I'll buy like a public stock, like Johnson & Johnson or something, right? Or a pharma company. So almost all investors have a specialty. So I think what the most attractive category is almost doesn't matter, because at least from a founder's point of view, Samir, because you want to build what you want to build, I think, right? And it's like art, right? Like Picasso had to paint, right? Jimi Hendrix had to play that guitar, right? It just had to, whether they're going to get paid or not. Van Gogh, he didn't make any money in his own lifetime. His paintings only got very expensive after he was gone, right? But he had to paint. So if you have that kind of motivation in a space, hopefully that has commercial potential, and whether it's mobility or infrastructure or curing cancer or whatever it is, going to the moon, there will be investors there too. So I don't think there is a most attractive, but if there was, yeah, I guess I'd choose AI B2B SaaS also. All right. Samantha's back again. Okay, Samantha, you're the frequent flyer miles tonight. We heard from an M&A firm that we need around $1 million ARR in order to get a fair acquisition price, but that price, why would we sell? Do you think it's better to be a recurring revenue model alone? Well, fair acquisition price leaves a lot of room, right? So I don't know how much you know about M&A, but any sort of financial transaction like that is generally calculated on some kind of discounted cash flow model. And the shorthand for that is multiple. So if you're trading on $1 million, if you're trading on a revenue, a multiple of revenues, and you could get a 6 multiple on 1 million, you get bought for 6 million, and maybe that's not enough. Other times, a similar business, just depending on other market conditions, might get a 20x multiple, and the same thing could be in a different market scenario, might be worth $20 million, right? And that might be more than fair as an acquisition price, right? So until it gets to the time where you're really actually live, and you can evaluate using current interest rates and forward curves and stuff, I'm not sure you can judge too much. It sounds like you're early enough stage that I wouldn't worry too much about the financials. If you have a proof of concept where you could deploy 30 of your hardware units and it's an AI related opportunity, which to the previous question is pretty hot space, I think I would just get on with it. And you're going to need to hire somebody who really knows numbers anyway. And if, you won't want to get ripped off. But if people start coming to you with offers, that's a great time to hire somebody, right? Or even just an attorney. You can engage an attorney. And if you need, actually anybody here, if you need referrals for a good startup attorneys, I don't mean like your uncle who does car accidents or your cousin who does divorces, right? I mean a real startup attorney. We have a bunch of those, are friends of mine, and there's a form at startupcouncil.org that you can fill out and tell me what you want and what your questions are, and I will connect you directly to some top people that I know that do this all day, every day, and they'd be happy to talk to you about this kind of stuff. So do you think it's better to be a recurring revenue model alone? Alone in terms of, I'm not sure what you mean. Recurring revenues are great, as opposed to what? You mean like a one-off purchases or something? I'm not sure I understand that part, but yeah, but the skepticism inherent in your question, I'll validate, right? At that price, why would we sell? I think you always need to ask that question. Why would we sell, and how much would we sell, right? You don't have to sell the whole company. You can sell pieces, right? Or you can sell a piece of it now and contract to deliver a piece later, right? You can do anything you want in legal terms. Good attorneys can document any kind of arrangement you can think of. You can license out part of it and then have rights to buy it back. Or if it goes this high, you get a bonus, or it goes down, you get a bonus, or whatever. You can put any of that into a contract and construct things just the way you'd like so that you feel that it's fair. And of course, the definition of any transaction is both parties have to decide that they think it's a good deal. So that can take a lot of negotiation. And again, that's where you'd want good attorneys. But in general, I think I would drive towards getting that million ARR, and then you're going to have a lot of options, and that would be fabulous. And that's exactly why I do this. I would hope that that's for you. And I think you're in Orange County, so you might want to join the Orange County version of the Startup Council. This was the first Startup Council right here in Southern California. And you can come join us, and I can introduce you to attorneys who are here, actually, right here in Orange County, if that's helpful to you. All right. What does that say? Okay. Service-based concept. Sorry, I need a drink here. Is it realistic to go public? Sorry, guys, I've been talking nonstop. Is pet boarding realistic to go public? It could be boutique pet. I don't know. It depends on where you are and how you build it and what kind of business model you have. Like, do you own the kennels or do you lease them, or what kind of pets are you talking about? What are the costs, and et cetera, et cetera. In the grand, larger vision scheme of things, yeah, I mean, there's lots of pets in the world, and there's lots of them need boarding, right? So that is a real business for sure. If it qualifies to go public or not is more a question of corporate strategy and growth, and like how you finance the thing to grow it large enough, quickly enough that people would want to buy the stock. That's almost a different game than the actual service of the pet boarding. But yeah, in theory, I would think so. All right. Daniel from SD Thinking San Diego there. 2 tech co-founders with a near final MVP. AI communications engine for core. First-time founders seeking advice on next steps. Any tips on early stage funding or angel groups to connect with? I'm curious what AI comms engine for core means. Let's unpack that. The AI communications engine for core. Or corporates, maybe you mean. Companies? You don't mean the Marine Corps, I don't think. I don't know. Okay. Anyway, near final MVP. Okay. Tips on early stage funding, angel groups to connect with. Okay. So San Diego's got a lot of great folks, and you probably know some of them. Some of them might even be on the call here with us. I would look at Jonah Peak has a newsletter called something Coyote, Social Coyote, I think it's called Social Coyote. And Social Coyote covers like all the events and stuff for startups in San Diego. Neil Bloom of Rising Tide Partners, I think is what his group is called these days, is a great guy and also very dedicated to helping founders. Mike Kren, I know a lot of people in San Diego, Yeah, I think they're a Google away for you to find a whole bunch of them. And my biggest tip would be to go and attend as many events as you can so that you meet the people and learn the language and make friends so that when you're really ready to raise that money, you're not a stranger. That's what you're trying to avoid. You don't want to just show up with your hat in your hand looking for money and they've never seen you before. And along the way, you'll pick up some of the lingo and build those relationships. So I would do that. There's also the biggest angel group, I think, in Orange County, in San Diego, is New Fund, NU Fund, that used to be part of Tech Coast Angels, which is where I've been investing for many years. And New Fund does a lot of early stage stuff in San Diego as well. But there's a lot in San Diego. So I think a Google or two, and you could get there pretty quickly. If you have more specific questions, we can get into that as well. All right, let's see. Current projects I'm guiding now are fintech and SaaS compliance. I don't want to take on more projects without getting these to at least phase 3 where deploying an entry market. Yeah, that makes sense. Sounds like you've got good stuff going on, though. Good for you. Okay, and then back to the pet boutique. Silicon Valley investors should get behind a pet boarding in West Australia. I'm ready to scale, infrastructure already close to takeoff. Well, that sounds great. I think you're gonna have to do a little more than show up here and ask, though. You probably need to do some research about specific investors who might be into that kind of thing. One of the things, just to hopefully this is helpful, if you say Silicon Valley investors are mostly software people, and a pet boarding operation sounds like a real estate type physical assets sort of play. Or maybe an Airbnb for pets or something like that. If it is more real estate and actual dogs and dog food than software, Silicon Valley investors are less likely to be interested, just so you know. Silicon Valley is looking for scalable businesses like an Airbnb that really is a software platform, maybe that you could sell to pet boarders all over the world. That would probably be more interesting and have more potential of getting Silicon Valley type investors. What happens to angel investors when a startup doesn't grow? We lose our money. Yeah, it sucks. Yeah. Well, if it doesn't grow, that's one thing. And that's kind of frustrating. It can just get locked up, right? Like I'm in a company now that I invested in first time probably, 2018. And then again in 2020 or so, 21, something like that. And they've been doing fine. They're still alive, but it's 6 years later from the second investment, and they haven't raised any more money, and they haven't gotten any much bigger either. They're just kind of running. So I own a small piece of something that's just running, and it's probably not going to exit. So in other words, I kind of lost my money, even though the business didn't go out of business. They just didn't get big enough to be acquired or exit or IPO or something, right? Because obviously the idea was put some money in and then it goes 10x and I get 10 times the money back, and the founder gets 10 times the share that they had back, and they're rich, right? So they're just supporting themselves and doing okay. But the investors, me and the other people put the money in, we're just kind of stuck. Of course, the other alternative is that the company just goes under and then the money just disappears, right? Everybody goes home. So it's not, for example, it's not like debt, where if you take a loan from somebody, a bank or your cousin or whatever, they're going to want that money back, right? So if the company isn't doing well and it runs out of money, they will shut down the operation, and whatever money is left, like in terms of maybe there's some in the bank account, or you can sell some of the assets or inventory or the chairs or the computers or something, get some money back, and then that money is distributed back proportionally to the debt holders, right? So you might get whatever, 12 cents on the dollar or something. You might get something back and the company gets liquidated. Venture capital doesn't work like that, or angel investors. The money goes in, you hope it takes off like a rocket, and if it does, you get a bunch of money, and if it doesn't, the money's gone. Not anybody's favorite reaction. Okay. All right, a lot of questions tonight. I'll do a couple more here. How long is the entire investing process? Okay, from first meeting to the company receives money from angels and VCs. That depends a lot. It's a good question. Let me give you some real numbers, then I'll explain why. The shortest might be 2 or 3 weeks. Longest could be infinite, obviously, but but a still successful raise that took a while might take like 5 months, 6 months, something like that. So something like a few weeks to a few months is typical. Now, the funny thing about this is that when they're slow, it's as often the founder's fault as much as the investors, because the investors, we actually do this more than founders do, right? So I've heard many times founders complain that it takes so long, but a lot of times it's because the founders weren't actually ready. So if you're going to raise money, you want it to move quickly, you have to be ready, right? We are going to ask for everything, all kinds of due diligence documents, and you want to be ready with a founder's agreement and a clean cap table and cleanly incorporated in the U.S. state of Delaware as a C corporation. You want to have board meeting minutes and assignments of intellectual property from all your staff and contractors. You want to have projections and copies of all your agreements and customer agreements, and I mean, like everything. There's like 10 different folders. This is part of another presentation that I was doing just last week in Pakistan that I mentioned actually. But there's a lot of stuff. So a lot of times the investors may be more ready than the founders because we know what we want, because we do this all the time, right? So we want to see these 10 things. And then when you give me those 10 things, I want 10 more. And you give me those 10 things, I want these 20 more, right? I mean, there's a list for us. Check, 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 check. But for you, it's like, oh my God, you're serious? You want this signed document of that first contract with the coder that we used 4 years ago in Romania, who wrote those first lines of code? Yeah, absolutely we do, because that's a claim of ownership on the proprietary intellectual property of the company. So, that kind of stuff can really slow things down. But if you want to move quickly, the trick is to be prepared. All right. Hope that was helpful. Give me some thumbs up, guys. Hopefully I'm answering these things. It's taking me a while to get to them, but if these are filling in blanks for you, please let me know. And again, like I said, likes and shares and comments, all that kind of stuff, really much appreciated. There it is. The captions are working again. Yeah. So please do let me know what you're thinking, because those little clicks help us stay on the air. All right. I will definitely, what's this? Reach you in JB. I am in Durban. I represent JSM. Okay, so I think you guys in Africa are talking to each other. Awesome. Okay. I have a potential opportunity to leverage commercial space on Huntington Beach. Curious to learn what are some cool things that I'm interested in a potential new co-working space. Okay, Ethan, that's interesting. Huntington Beach, that's Southern California, near me. And yeah, co-working is a thing for sure. I don't know much about that. That's a very specific business model, right? So I'm sure there's people you could talk to about that. And if nothing else and it ends up being an event space, let me know. Well, maybe the Orange County Startup Council can come down there and have a Christmas party or something. All right. So I think we're just about running out of time here. Thank you, Suresh. Appreciate that. And John as well. Thank you. Just good to know I'm getting the job done here. And Daria says, can I have a single person startup? 25. Sure. You can do whatever you want. If Daria, just by your name, I'm guessing you might not be in the States. The US has probably the simplest legal and regulatory regime for starting companies. We don't really need to really do anything. You can just start selling stuff. If you succeed in selling stuff, you're going to want to get some licenses and permits and probably incorporate and open a bank account, and you'll get there soon enough. But we don't actually have to do much of anything to start. So, but if you are perhaps like in India or in other jurisdictions that I don't know as well, there are other things that you need to do. Because I know, like in India, for example, I see all the time people put on their websites and stuff that they're an official startup, like they're licensed by the government, and that's not a thing here in the United States. So there may be more that you need to do. But the fact that you're 25 doesn't scare me. Of course, you can do that when you're 25. Mark Zuckerberg famously dropped out of college. I think he was 18 or 19 when he started Facebook, right? And that certainly went well, at least for him. You should read, Dari, if you're that new to this, you should read one of my books. This middle one, Click Millionaires here. This is available all over the world in many languages, including English, of course. That would probably be really helpful to you, actually, because that's why I wrote it, was to help people start their first business. Even not necessarily a venture capital business, but just a internet-based business, because that used to be a new thing. So, okay. So I think that's about it for tonight. And lovely to see you all. I appreciate your being here. And if you wanted to get a copy of this fundraising PDF, that's the URL on the screen there. And you can send me feedback on this as well. I didn't get to cover all these points, but hopefully it's somewhat self-explanatory. I do this to try to help, so likes and shares are appreciated. We'll be back again in a month. And like I said, I'm going to start doing probably at least twice as many of these, especially once I can get this new book done. We'll be here talking about the book, right? So hopefully you all can participate in that, and love to see you again, of course. And then we'll have plenty of other opportunities to get together. And let me just see if there's anything else I want to tell you here before. So yeah, new book is coming. And then join us at startupcouncil.org. I guess that's it. Okay, so great to see you all. Thank you for joining me. I'm Scott Fox from startupcouncil.org, doing my best to help accelerate you in your startup dreams. And I hope to see you again soon. If you haven't already, come join our newsletters and join us as a member at startupcouncil.org. We'll help give you a lot of publicity for your startup and introduce you to service providers, potential clients, investors. We're building the whole network there, an army to help accelerate the world and accelerate your future as an entrepreneur too. Thanks. See you next time.